All right, thanks for joining me again today. We're going to be looking at some Forex basics. I just want to try to help you understand, how the market works and how you can get involved in this. So, first thing we want to talk about is currency pairs. Currency is always traded in pairs, and that's the only way that we can make a comparison to what a currency is worth. If we had one worldwide currency, there would be no FX market. So the only reason that we're able to do that is because we have different currencies and we can make comparisons to what they are worth. In every major pair, which we're going to talk about major pairs on the next slide, you will notice the US dollar is in every single major pair. And we'll go over the reasons for that a little bit later. So you buy one currency and you sell another. It's a simultaneous transaction. You will trade through your broker, and that is usually, if you do it online, it's just like an interface. They'll have like a little program that you can use to facilitate the trading, but they're actually doing the transaction themselves. The euro and US dollar, this is an example of a pair and how you will see it written. EUR and USD for euro, US dollar. Another pair is the Great British Pound and the Japanese yen. That is exactly how you'll see them. Let's go ahead and take a look at the major pairs. We've got, again, the euro dollar, and to the right over there, that's how you say it. So we have the euro dollar, the dollar yen, pound dollar, dollar Swissy, which CHF is the Swiss franc. Dollar loonie, the loonie is the Canadian dollar, the Aussie dollar, and the Kiwi dollar. And there are also cross-currency and minor currency pairs. So there will be other variations because we know that there are other currencies in the world. But these are what are called the major pairs. Now, I mentioned to you before that the US dollar is a part of every single major pair. Typically, what you're going to see is that the stronger currency is listed first. That's why we have the euro dollar. And then the dollar yen. So the stronger currency is listed first. The US dollar, though, is what is compared, like most of the other currencies in the world are going to be compared to the US dollar. Just the way it is. We're the strongest economy, or at least the largest economy. The US dollar is half of every major pair, and the majors constitute 75% of all trades. So that tells you that the US dollar is very important and you want to keep an eye on what it is doing. The US dollar constitutes 62% of all world currency. So everybody's watching the dollar. The United States is the largest economy. The US dollar is the reserve currency of the world. We've got the most stable political system, the world's sole military superpower, and the US dollar is the medium of exchange for many, if not most, cross-border transactions. For example, let's say that you were the government of Mexico and you wanted to buy some oil from Saudi Arabia. Well, Saudi Arabia only sells oil by the US dollar. So if the Mexican government does not have any US dollars, it will have to exchange its pesos for dollars and then purchase the oil with the US dollars. Now, speculation is where you're analyzing what the market is doing, and then you're speculating or guessing what you think the market is going to do based on what you have seen so far. Speculation accounts for 90% of the trading volume on the Forex market. That means by far the majority of all trading is done by speculation. People buying and selling currencies, speculating on what that currency is going to do. That means that the FX market is very liquid. You're not, no single entity is going to be able to affect the prices on the market. Simple as that. Let's talk about some ways that we can trade. And I realize this is like a crash course for you, right? We're just kind of getting you up to speed on some of the terms and what goes on. By no means can you just start trading, just because you watch this video. You can learn and you'll learn enough to learn some more. The spot market is when trades occur right then and there with current market prices. So you go in, you see what they are, you say, give me, $500 worth of this, and then you watch it, and then you could maybe, do something. You can sell it then 5 minutes later if you want. Futures. This is a contract to buy or sell at a specified price on a future date. That's why it gets the name futures. So you're agreeing, I will buy, $5,000 worth of euros at some future date. Now, that is a binding contract. An option is where you have the right but not the obligation to buy or sell at a specified price on that expiration date of the option. So in that case, it's like a future, but you're not obligated to buy. You don't actually have to. And options are, actually, they have value in and of themselves. You can sell options to other people if you want. Exchange traded funds. These are new. They're called ETFs. They're like, for example, it might combine stocks with currencies. These are put together by financial institutes, and they can be traded just like stocks. Okay, so a lot of different ways that we can trade. As a day trader, for the most part, you're going to be dealing with the spot market. Now, the FX market is very attractive for a number of reasons. For one, the commissions. There aren't any exchange fees, no brokerage fees. The brokers are paid through that bid-ask spread. So you know what the spread is when you buy, and it's factored in there. There's no fixed lot size. So, like, for example, if you were buying silver, you'd have to buy like 5,000 units of silver. Well, that's not the case with FX. You buy as much of the currency as you want. So there's no specified amount. It's a 24-hour market, so you don't have to wait for some bell to ring to get going with it. You can trade all over the world 24 hours a day. It's closed on the weekends, though. No cornering of the market. The Forex market is so huge, nobody, not even Chuck Norris, can control the FX market. And leverage. A small deposit allows you to control a lot of money. Let's say you had a 50-to-1 leverage ratio. That means if you had a $500 account, you just put $500 in it, you can actually buy $25,000 worth of currency. Then when you sell that, any profit or loss affects your $500 deposit, your account. If you made $50, you now have $550. If you lost $50, you now have $450. So it's all tallied up once you close your position. Now, this is just the beginning. Not only do you have to learn all these terms and things, but you have to learn the strategies that you're going to use and how you read charts and all that kind of stuff. And it can be pretty daunting. Like I said in the first video, though, you don't actually have to learn all this. You can have what's called an expert advisor, which is a little software program. They also call them robots. You can have that expert advisor do the trading for you. And if you get a proven expert advisor like the one I'm recommending to you here, then what you're going to get is a piece of software that's going to monitor the market, and based on the strategy that it uses, it will enter and exit trades automatically for you. So give that link a click, check it out, and I'll see you around. Thanks.